I'll be a bit ironic here, but, crypto is crypto. Crypto is big, worldwide, global license. As you say, it takes 2 years, probably a lot of money, a lot of time, a lot of effort, writing, forms and all that kind of stuff. Why a license? Really? You need a license? Why that?
Well, trust me, at times we've asked ourselves the same question when we had to answer those long forms. No, but with our value proposition, our approach of being a serious regulated player, catering to very regulated institutions, for us, it is absolutely key and necessary to have a high regulatory standard and have that basically stamp of approval for the client base that we work with, right? I do believe there's a lot of business models within the digital asset sector that maybe don't require a license, right? And I think everybody, depending on where they position themselves, needs to think very hard, what kind of licenses do I need? Like which ones are necessary for client acquisition, and which ones maybe we don't need. For instance, we are a broker-dealer. We're not a fully licensed bank that can take deposits because that's not part of our business model. We don't do custody, so this is something we kept out of the licensing step. So I do believe, because it comes at a cost, right? Let's be very honest. You need to think very hard, and I think this is where RULEMATCH and tradias are very similar. RULEMATCH, of course, has taken a similar approach in catering to very similar clients. And I think those grown-up players are needed to drive institutional adoption.
Hello and welcome to another episode of RULEMATCH Spot On, the only podcast focused exclusively on the institutional crypto and digital asset industry. My name is Ian Simpson, and if you want to know what banks, hedge funds, asset managers, trading firms, and others are doing in crypto, and more importantly, how they're doing it, this is the place for you. My guest today is Chris Beck, founder of tradias, a spin-out of Bankhaus Scheich in Germany, with offices in Frankfurt and Munich. Chris is here to talk about what tradias is doing in OTC trading and market making, as well as a range of other topics, and we'll dive into all of that on the podcast episode today. Chris, welcome to RULEMATCH Spot On.
Yeah, thanks, Ian, for having me. Glad to be here and looking forward to our conversation.
Chris, I wanted to start with maybe a little bit of a controversial question or tricky question, and maybe the answer seems obvious, but in your opinion, is now, given current market conditions, a good time for a bank to be starting in crypto? Again, the answer might seem obvious, but I'd be interested in your take on that.
Yeah, for sure. I think it's a good time to be in crypto, right? And the train clearly, in my opinion, has left the station when you look at the market developments over the last few weeks. And then on top of that, the developments on the government side, right, and the regulatory side. I think it is clear that crypto is becoming more and more of a mainstay, even in traditional finance. So from my opinion, with the recent developments that we're seeing, banks have to now adopt crypto and adopt digital assets, whether they like it or not. And that's clear development we're seeing at the moment as well.
So some of them have already been in the space for some time, and we'll talk a bit more about that. And then some are just now getting themselves set up. Maybe some are thinking they can get the fast follower advantage after maybe first movers have already been around for a while.
Yeah, I think that's correct. And, when you talk about banks, I think you have to understand that they always come from a risk management perspective, right? And I think maybe in the past, some banks have decided that potential reputational risk or other risks have outweighed the potential of getting into digital assets. I think now they're seeing that the risk of actually losing customers or losing market share because of not being in digital assets is maybe outweighing the reputational risks that were an issue before, right? So the speed of which they can move into it remains to be seen, especially for the larger banks. But I do believe that, you see that sentiment shifting even from people that maybe are not 100% convinced about the asset class overall.
Mm-hmm. And your background is TradFi, and we're going to be talking about that crossover between TradFi and crypto today that, of course, for institutions now coming into the space requires that there's a bit of a mind shift for them, now looking at a totally new asset class. And yet at the same time, like you said, they still have to stick to procedures, processes, regulation, of course. How do you think that mind shift or that mindset shifts for classical bankers as they see now it's a risk not to be in crypto?
Yeah, I think, and speaking from my own experience with a traditional finance background, I think there's a lot of stuff that you can leverage from the traditional finance world, especially as more traditional players move into the space. I think we've seen it with the ecosystem growing up over time, right, and becoming more of an institutional ecosystem, right? This is something that I think, a lot of the bankers or bankers that are thinking about moving into crypto can leverage. At the same time, I think the biggest challenge to adapt to is the speed at which the industry is moving, right? This is completely different, in my opinion, from the traditional financial world. And this is something individuals and also the institutions have to get comfortable with.
Mm-hmm. And there's famously some people in crypto, for instance, Joe Lubin from Consensus, was at Goldman Sachs, I believe, and some other financial institutions. That is, a real paradigm shift. And yet, as you say, you can't leave everything behind, because if we want institutions to be active, we still need to think in some sense from the perspective of banks and asset managers and so on and so forth, right?
Yeah, absolutely. I think when you look at it, and speaking also from the perspective of tradias, how we approach it, striking the balance between offering some sort of familiarity with the system, right, and the processes that you're using, which maybe can be somewhat similar to traditional finance, while leveraging the advantages of the technology and the tremendous efficiencies you can leverage. That is really the balance that you need to strike and need to hit, right? And that is a continuous challenge. But I do believe that some processes in the traditional financial world are there for a reason, right? And we shouldn't neglect that or say anything was bad. At the same time, I think the advantages of DLT are obvious, and it's time to embrace them. Whoever can hit that balance, I think has a very big advantage in the digital assets field for sure, especially when catering to institutional investors.
Mm-hmm. We sometimes think about even the market landscape in traditional finance versus crypto assets. And, many things have been developed over the years for traditional assets, market infrastructure, rules, processes, AML, all of that. And on a scale, it's all green, right? It works, it functions, people make money, people make a lot of money. And then an institution who's used to that then comes to crypto and sees, this is not quite that level, and here is missing this part, and I'm not sure about this. It's yellow, red. That's a bit of a challenge, right? To find your way in this new space when you're used to something that works so well.
Absolutely. And I think making those compromises in areas where banks historically have not been very willing or comfortable making compromises is really a big challenge, right? And that's also why I think the adoption has taken a bit longer. We know it ourselves as a BaFin-regulated entity, things like AML in particular, right? Compliance, counterparty risk, these are all challenges where, of course, you're now dealing with a different setup and different market participants than what you're used to from the traditional world, right? When you trade with the top 20 banks globally, they certainly have a different risk profile than maybe some of the incumbents in the crypto space, right? So then the question becomes, how do you manage that risk? How comfortable are you taking on how much risk, right? And I still believe that a lot of the processes, though, the underlying processes that traditional banks have, can be used for that, right? The question is, are the banks willing to embrace that and have some kind of flexibility where you really look at the chances and the risk profile and adapt.
Mm-hmm. We'll get into a bit more on the details of how you were set up and so on, but just stepping back, Tradias, coming from maybe the traditional financial world now, working exclusively right in digital assets, what was the big picture vision or focus for you in starting and getting this off the ground?
Yeah, for sure. Having worked in traditional finance and always on the trading side of things, what I realized eventually is that the processes we had at the banks were extremely inefficient, right? Our trading desks, as you said, made good money, but when I looked at the amount of people that were dealing with, let's say, the back-end processes of the trading side, settlement, etc., it became apparent to me that there must be something out there that can revolutionize the financial system. And to be honest, I think when you look at the financial markets, it's one of the only industries where we haven't really seen a big leap in innovation over the last 20 to 30 years, right? When I look at the differences between digital assets and the traditional world, to me, the biggest difference was the culture shift, to be honest. I mean, number one, moving from a big company of 100,000 people to starting my own business. But then number two, how collaborative the entire industry is. I think everybody who was willing to take that step away from maybe a good job in the financial services industry into crypto or digital assets has the idea that we're early movers. And if we work together, we can really create something here and everybody will benefit. And that mind shift from a very competitive field, a mature field where you're basically fighting for market share with your competitors, to a field or an area where everybody's working towards building something and building a new ecosystem, that probably for me has been the biggest difference. And change.
Getting into the nuts and bolts of it, then Tradias is a trading company, right? It has a focus. It has a sweet spot. What would you say is the sweet spot or the narrow focus of what you're doing? Yeah,
as a fully licensed broker-dealer in Germany, we're solely focused on enabling institutions to offer digital assets and cryptocurrency trading to their clients, right? So we really see ourselves as a market maker, liquidity provider, and infrastructure provider in the background to enable our client base to adopt cryptocurrencies for themselves or for their client base. We like to work with multipliers such as banks, neobanks, exchanges, brokers, because again, we don't see ourselves as a big marketing house or aggressive marketing house. We really want to focus on what we're good at, which we believe is the trading side and the market making side, and enable as many institutions as possible to adopt cryptocurrencies and digital assets into their product offering.
So you've had a lot of back and forth with institutions and understanding what they like, what they don't like, and weak points, strong points, and so forth.
Yes, absolutely. And I think that's also why we chose that path, right? Because that is where, speaking of the founding team and also the management team that we have in place, that's what the experience is, right? So I think we have a very good understanding of the do's and not to do's for some of the institutions, what they actually need, and some of the hurdles they need to overcome, right? So a lot of times, apart from educating the institutions, it's also understanding, okay, which departments internally are usually the roadblocks for any digital assets project, right? And how can we enable the business units to basically overcome those roadblocks internally to enable the project?
Making other people's life easier. I think that's something we also try to do at RULEMATCH, so we understand that quite well. You received a license. You mentioned being licensed from BaFin. Just walk us through that, what that means, what that entailed, how that went.
Yeah. For sure.
Small thing.
Went very smoothly, of course, as you can imagine. Maybe to understand, but we have to look back a bit how Tradias started. So we were in a lucky position to work with a very close partner of ours, Bankhaus Scheich, which itself is a securities trading bank in Germany. We were able to leverage their licenses early on to get the business going. The idea was always to have Tradias operate as its own securities trading bank with its own licenses as a standalone entity. Therefore, we've applied for the licenses. The process took roughly 2 years, so not an easy process, as you can imagine. We thought it might be easier because we already have existing business. Turned out didn't really make a difference in the process, I believe. But nevertheless, very lucky now and very happy to have the license. This now means going forward that we can operate as a fully standalone entity, which was always a goal and is very important. And with MiCAR coming into place, and I'm sure we're going to talk about the outlook maybe a bit later, the timing is perfect. Now it's about really, of course, making a company ready for that expansion and
building things up. Now,
exactly.
I'll be a bit ironic here, but crypto is crypto. Crypto is big, worldwide, global license. As you say, it takes 2 years, probably a lot of money, a lot of time, a lot of effort, writing, forms and all that kind of stuff. Why a license? Really? You need a license? Why that?
Well, trust me, at times we've asked ourselves the same question when we had to answer those long forms. No, but with our value proposition, our approach of being a serious regulated player, catering to very regulated institutions, for us, it is absolutely key and necessary to have a high regulatory standard and have that basically stamp of approval for the client base that we work with, right? I do believe there's a lot of business models within the digital asset sector that maybe don't require a license, right? And I think everybody, depending on where they position themselves, needs to think very hard, what kind of licenses do I need? Like which ones are necessary for client acquisition, and which ones maybe we don't need. For instance, we are a broker-dealer. We're not a fully licensed bank that can take deposits because that's not part of our business model. We don't do custody, so this is something we kept out of the licensing step. So I do believe, because it comes at a cost, right? Let's be very honest. You need to think very hard, and I think this is where RULEMATCH and tradias are very similar. RULEMATCH, of course, has taken a similar approach in catering to very similar clients. And I think those grown-up players are needed to drive institutional adoption.
Mm-hmm. And so without causing any trauma as you look back on that 2-year process, but I'm sure there were certain fundamental things that you had to look at. You mentioned some things before about risk and systems and processes. Can you give us just a short list of some of those big considerations that you made in setting things up and then interacting with the regulator? Yeah,
for sure. I think, the biggest considerations certainly revolve around risk, AML, KYC procedures, but also, of course, the tech infrastructure, right? As you know, and I'm sure this is also something where RULEMATCH and tradias are very similar. We want to have a lot of automated processes because that creates scalability, right? But whenever, of course, things tend to be very automated, the regulator, in this case BaFin, wants to understand how it's actually working, what are the risks, what are the threats, outsourcing processes, etc. Right? So we're now roughly at a headcount of 95 people. A big part of that is certainly tech-driven as a fintech, but also on the regulatory side, risk, AML, outsourcing management, etc. Because I think those are the aspects where not only in Germany, but as I think in Europe, the regulators are paying more and more attention. And going forward with DORA and some of the new regulation that's coming into place, this is something that will be a heavy focus from the regulators going forward as well.
Mm-hmm. Yeah. And that process, started 2 years ago. Now it is finished in that sense, but you alluded to MiCAR. I don't want to make this a big, long MiCAR segment, but I don't think we can maybe avoid it. What of the parts of MiCAR that we see or that we understand at this point figured into your considerations for that license and for things going forward? Yeah,
for sure. I think one of the advantages for us is that as a fully MiFID licensed broker-dealer, right, that can also interact with any sort of securities, that actually made a second step now, meaning the MiCAR notification, a bit easier, right? Because we didn't have to apply for a whole new MiCAR license. We basically notified BaFin and gave our MiCAR notification. That happened in November, right? And the second advantage I think that we have is that, as far as we understand MiCAR, I think you phrased it well there. A lot of the aspects are largely based around the existing German regulation, right? So this is something that helps us because when we looked at our processes and basically did a gap analysis and mapping of what we had during the licensing process for our German licenses and what we need for MiCAR, the gap was very, very small, and we made sure that basically all the processes are fully MiCAR compliant. So we view that as an advantage. And the first step was probably a bit harder, but made the second step a bit easier.
Yeah. And just going back to that phrase, understanding MiCAR as it is today, is there something, again, maybe a bit of a controversial question, that for you isn't clear yet on MiCAR? Is there some things where you think we could perhaps hopefully see some more clarity, some more understanding of things?
Yeah, I think there's two aspects maybe I would point to. One thing that we've been taking a deeper look in internally and maybe we get the chance to talk about this in more detail a bit later, is borrowing lending, because I do believe that borrowing lending or a functioning borrowing lending market is something the institutional space will need in the crypto space in order for it to grow. And I think the regulation here is still a bit unclear of sort of the do's and not to do's and where the boundaries lie in terms of borrowing lending. The second one I would add here is that I remain very curious to see how the local authorities will basically interpret MiCAR in their own way, meaning will, for instance, foreign broker-dealers have a very easy pathway to just open up shop in France, Germany, etc., some of the more regulated countries, even when they maybe have locally somewhat lighter KYC, AML requirements, right? Because in the past, even in the traditional world, what we've seen is that, yes, you have a so-called harmonized European market, but local regulators still made it very hard for some of the, let's say, lighter jurisdictions to export into heavier jurisdictions, right? And I could see that for the digital asset sector as well. Yeah.
We had one guest on the podcast. Maybe you listened to him previously, who worked actually on developing MiCAR, and of course there's a lot of talk around stablecoins. He gave a bit of color and context around background of that. It's probably obvious that some of that was inspired by the whole Libra story. Now stablecoins become a big thing internationally, but now with MiCAR, that's kind of maybe more in a box. How do you think about stablecoins within Europe and more globally? Just some insights.
Yeah, listen, I think in order to really leverage all the efficiency effects that I alluded to early on, I think you need basically both legs of the transaction to be on DLT, right? And for that, you need functioning stable coins. We've seen in the US early on with USDT, USDC, of course, private initiatives basically that were able to capture tremendous market share and establish themselves as accepted or widely accepted stable coins. I think on the Euro side, we didn't see that. I think early on, it's somewhat obvious why that didn't happen. You had negative interest rates, so the business model of stablecoin issuers in the US wouldn't have worked so well in Europe. Of course, that has now passed, and I'm a bit surprised nobody's been able to fill that gap. I think there's a couple of reasons maybe for it. I do believe regulation in Europe running stablecoins, has been more stringent and a bit harder maybe to launch anything similar. And the second one is, I think, market participants that are more crypto native probably adapted by then to the US dollar denominated market, and you see it in terms of the volumes, right, where it's going. But I do believe it is a big bottleneck that needs to be solved for the European market. And you see now the first initiatives, Euroc, of course, received the official stablecoin labeling, basically, and SocGen is working, of course, or has been issuing their own stablecoin. So you do see some initiatives, but I think to really take off, you need one stablecoin to emerge, or one or two stablecoins to emerge as very liquid, widely accepted stablecoins, and it would make our life a lot easier. So I'm hoping for it.
Some people say with MiCAR coming that it will kind of put this curtain around wall around Europe in some sense. Do you get the feeling that is the case, or will we still continue to have a pretty global 24/7 crypto market? When we talk just about crypto assets, not getting into digital securities and so on.
Yeah. To be honest, I do believe it will still remain a very global market. I mean, you see it, I think, especially after the launch of the ETFs, how concentrated market movements are around the US sentiment, basically, right? You also see that the volume is largely concentrated around the US market open, US market close, which has always been the case, but really that concentration has increased over time, right? And I don't think you can hide or run away from that by putting a regulatory umbrella up. I do believe for Europe it's a great step forward because you're going to have a harmonized market. I hope that will make the European market more relevant compared to the other global markets. And but yeah, I don't think it's going to decrease, let's say, the international interaction with the other markets. Yeah.
So regulation being one thing that is different in different places. Let's just go back to banks for a minute and talk about banks and their mindset. We had a guest on a little while ago from Fireblocks, and we were talking a bit about the difference in mindset between U.S. banks and European banks or international banks. There, I think some of the reasons for U.S. banks being slower is clear: regulation, Gary Gensler and company. But if we look at another matrix or another way of looking at it from geography and from size, what about European banks versus Swiss banks?
Yeah.
We've had, I think, now 34 banks in Switzerland doing something in crypto, according to FINMA's own report. I don't know if the percentage would be quite as high in any other European country. Probably not. What is your experience or your insight on working between European banks, Swiss banks, and some of that?
Yeah, for sure. No, I think when you look at the comparison between Swiss banks, European banks, the Swiss banks definitely have been a lot more progressive in approaching digital assets. I think there's various different reasons for it, and the two major ones I see is, we talked about regulation a bit. I think FINMA has been very progressive in that sense as well, especially early on. Also granted full banking license early on for some crypto native players such as Sygnum and Mina Bank, previously Seba Bank. I think that was in 2019. So really, really early, right, for regulation to take place. And the second thing is that I think when you look at the Swiss market and the banking market, of course, private banking, wealth management, high net worth individuals is a big part of the banking system here. Maybe less so in other countries within Europe, right? And I think that, of course, from a client-based perspective, this is a segment where you see clients pushing for products, right? When they see maybe an attractive return profile.
Banks, officially have the label of being super conservative, right?
Exactly.
But yeah, as you say, more client-driven.
Exactly. And when you see maybe client outflows to crypto platforms, and this is sometimes the conversation we have with banks that's really turning the switch. It's like they do an analysis, where's the money going? And if they see it go into platforms such as Kraken or Coinbase, that really makes them think twice whether adopting crypto or not. And I think, again, with the maybe client profile some of the Swiss banks have, that may have been another key reason for them to be more progressive in that sense. You see with the crypto adoption, I think Switzerland as of 2023 is at 21%. You look at Germany, for instance, at 12%, right? Average in Europe, I believe, a bit higher. But yeah, and then the question is that a supply or a demand side effect, right? Probably a combination of both. But I would definitely say you wouldn't see the same percentage on the European side.
Is it also maybe just a function of the size of the market? I mean, if European banks get their act together, then the market is huge and the potential is great. Yeah. And yet maybe a bigger market actually slows things down. With a smaller market like Switzerland, more competition, as you say, people can see outflows going here or there, so they have to keep up. Probably that plays a part too, right?
Yeah, absolutely. I think, we all know that the European, let's say, banking landscape is very fragmented compared to other countries, right? Certainly compared to Switzerland, but also North America, which is also goes to say that banks tend to be, I think, probably a bit more risk averse, right? As you said, slow to react or slow to adopt, maybe even if some banks are early movers. And as you mentioned, I think in smaller markets, once, I lived in Canada for 8 years, it's very similar. Once one of the 5 big banks decides to move, the other 4 follow immediately, right? It's just a question who has the courage to go first. And that can take some time, but once that happens, then usually you see the other ones falling through very, very quickly.
Interesting. On that point, somebody said one time, and I won't mention any names, but there are 2 large French banks. One has kind of the reputation of being more innovative, the other one a bit more conservative, but it almost always happens that the one takes a step first, and then the second one gets jealous and figures out they have to catch up, and it's 1-2, 1-2 all the time.
Yeah, totally. I would agree with that statement.
Won't mention any names.
Yeah.
But then when it just comes to size, it's interesting what you said earlier about knowing or understanding the internal teams and things. And that's, of course, a huge thing. We know that as well at RULEMATCH. When you are onboarding banks, there's many different steps and things that you go through, and teams and processes and paperwork, bureaucracy, right? That has to happen. At a big bank, when we talk about size, that takes a lot more time. At a smaller, private bank or a bank with a bit more initiative, that's a bit different. Is that your experience as well?
Yeah, for sure. I mean, when you look at the sales cycles, they can differ greatly, right? And usually there's a strong correlation between the size of the bank and the length of the sales cycle. I mean, we announced a partnership some time ago with DWP Bank. DWP Bank is basically the backbone bank for a lot of the community banks in Germany, so the Sparkassen and Volksbanken. Of course, here you have many players involved. It's also somewhat political, right? Because you have a lot of the committees from all the different community banks, and getting that set up in place took 2 years, right? Yeah. Really to get it over the finish line. But the great thing is, and I think this is something where probably RULEMATCH would agree, once you solve problems for those type of clients, right, they tend to be somewhat grateful and be really a partner for the longer term. Yeah. With the more agile ones, they remain agile, right? So
jump
exactly.
To the next thing.
Exactly. Yeah.
Interesting. Then also there's the thing about technology, right? Big banks usually have big budgets. They have big tech teams, but they also have big, complicated systems. If they're a global bank, they have, commercial investment banking, private banking, all kind of mixed together. That's a hurdle in some sense, right? Where a smaller bank maybe doesn't have the big budget, but doesn't have so much baggage as well. How does that work? And
totally. I mean, we see it especially with the larger banks and their core banking systems. Just to give one specific example, right? So with a couple of projects, actually, but one in particular, where quite late in the process, it was noticed that the core banking system could only handle a certain amount of decimals, maximum of 4 decimals, right? Which, of course, if you want to implement Bitcoin and offer it maybe to a retail client base, is not sufficient, right? And then we basically had to build a solution that integrates into the core banking system and is able to show up to 7 decimals just to basically fulfill the requirements on the reporting side to the clients. And this is just one example, right? So this happens quite often. And yes, of course, I think when you look at some of the, let's say, more modern neobanks, neobrokers, right? What we see there is really they're trying to have a microservices approach where they tend to focus only on what they believe they're good at and try to basically outsource or source very specific services, including the IT services from specialized providers. And of course, that makes them a lot more agile, right? I can understand why for bigger banks that might not work. Number one, the system has grown over time, right? To switch everything, of course, is incredibly costly and cumbersome. And the second thing is, of course, relying on partners might be seen as a bit more risky than having the control over everything. So, that's a decision the banks have to weigh. But absolutely, IT infrastructure is a massive topic. And again, not only I would say trading is usually not the most complicated piece, to be honest. It's really all the downstream processes that follow after it. Yeah.
And then, and this is something we've seen also from the RULEMATCH side, is that, even if a big bank wanted to get into crypto and then they were thinking of perhaps going to the market infrastructure that has been out there, again, mostly built for retail, WebSocket, REST API and stuff like that, it's all nice and well for certain things, but not exactly built for a global investment bank that wants to do business in this space. So then you get back to more standard technology fix and things like that, right?
Yeah.
And you would see more and more of that coming up as well.
Absolutely. I think that's a trend we're seeing. I think that's another similarity between RULEMATCH and our services. RULEMATCH's infrastructure is incredibly robust, right? Virtually zero downtime. It's the same with us, right? And I think this is a key aspect when banks look into it, because again, coming to my earlier statement, from a risk perspective, that's the first thing they're going to get asked. What if our provider is down? What if clients lose money because they can't trade? And we see that with a lot of the retail-based platforms, right? That during volatile times, they really do struggle with those sort of things. And also the pricing quality gets worse, the slippage gets worse, right? The execution quality gets worse. So definitely, that's a big factor we're focused on, and this is where traditional, let's say, setups might prevail. Exactly, can help. Yeah, and another factor with this that comes into effect is OMS systems, right? That's also a trend we're seeing more and more. Is applying best execution practices, of course, is very relevant for a lot of these players. So having backup providers, access to multiple venues is something that is really important for a lot of the clients.
Yeah. One thing that isn't talked about so much, maybe because people also aren't 100% certain about it, but banks do have to think about capital requirements. And depending on the regulatory regime and also how that develops with Basel requirements and so on, that can be quite difficult, right? So is that something you're working with the banks to help them set themselves up, even technically, trading-wise and so on, so that it is as capital efficient as possible?
Yeah, for sure. I think that's one key aspect of the considerations when banks look at it. I think in Switzerland with FINMA, you have a risk weighting, a proposed risk weighting of 800%, right, for crypto assets. In Europe, it's actually 1,250%. So virtually, you need to, for any euro
crazy
exactly crypto on a balance sheet, you need to basically have €1 of tier one capital or equity for it. So we have a lot of banks that say we want to offer spot crypto, but we cannot hold even €1 of crypto on a balance sheet, which, to be honest, sometimes with the gas fees, that becomes complicated. So we've come up with solutions where basically we avoid even the gas fees showing up on the balance sheet. And yeah, something we work with the banks. But to be honest, also something we need to be very conscious of ourselves. I mean, we are not a CRR credit institute, so our requirements are somewhat less stringent, but nevertheless, holding large amounts of crypto on the balance sheet would also be fairly punitive for us, right? So we try to be extremely efficient with our capital turnover, with our position keeping, and the risk we want to have on the balance sheet.
And then going back to what you mentioned earlier about the topic of borrowing and lending, which is another step in the maturity of the space, that also brings up the topic of capital on balance sheets and how you handle that. What needs to happen for that to mature and grow, in your opinion?
Yeah. I think, to be honest, this is why I mentioned it also in relation with MiCAR, right? I think that's where I would hope that the regulator is taking a step towards the business side, because with the underlying capital requirements, I think it will be very hard for any regulated entity to come up with a commercially competitive borrowing lending offering as a principal lender, right? Nevertheless, there's already clearly demand in the market for borrowing lending. So what that will do is it will drive participants to unregulated solutions. I think we've seen in the past what can happen. Yeah, exactly.
It doesn't end well.
Totally, right? And I think so the idea of the regulator maybe protecting market participants with those stringent rules, I think is doing in this case the opposite, because it's actually driving participants to unregulated solutions that can create exactly what we've seen, right? So that needs to change. I mean, we ourselves, when we look at it, it's always a question, can we stomach doing it as a principal in large amounts, or do we look towards an agency model, right? Of course, there's jurisdictions that are less stringent in that regard, where then maybe you can find good, high-quality principal counterparts that can take it on the balance sheet, right? But I think if Europe, and I think this is for the EU and Switzerland, wants to be competitive in that space, the regulation needs to move somewhat towards the business side.
Open things up just a little bit. Maybe also considering that the regulatory space in the US may be becoming more friendly, which creates some competition. In general.
Absolutely. I mean, we've seen the announcement now, Cantor Fitzgerald, of course, right? Looking at a borrowing lending facility with Tether, right? I think $2 billion to start. That's a huge step for the market, right? And hopefully that will, as you mentioned, increase competition between get the jurisdictions.
Wheels going.
Exactly.
Of course, this borrowing and lending, and also other parts, I mean, prime brokerage and things like that. Yeah. For hedge funds and for, real institutional players, shall we call them, people looking to really make big money in the space. That's key. From your background also, as I understand, in the hedge fund space, how would you be looking at this right now as a typical hedge fund manager coming into crypto?
Yeah, for sure. I think the reason the market for hedge funds has been and still is probably so enticing is you do have inefficiencies. Therefore, you have arbitrage opportunities, right? So especially for any quant-driven fund, this can be extremely lucrative. The reason that those inefficiencies exist is because the market is still extremely fragmented, right? And capital inefficient, right? You don't have, or you see the first functioning prime brokerage setups emerging, right? But historically, you haven't had those, right? Meaning that any sort of cross-margining was extremely difficult to get. But I think the market has realized this, right? You see players such as Hidden Road and others building up very, I'll call it mature prime brokerage setups. You see on the custody side, players like Fireblocks or Copper working on solutions that enable a faster settlement, faster movement between exchanges and whatnot, to basically have that cross-margining effect, which will maybe also decrease the amount of opportunities you see. But I think the key element for hedge funds to be successful in the space so far has not necessarily been seeing the opportunities, because that was quite easy. It's really how to take advantage of it in order to be capital efficient, right? So that's I think if I was a hedge fund manager, that's what I spend the majority of my time on, to figuring out the most efficient setup.
Latency hasn't been a huge topic up until now either, but that's also a game that hedge funds play, right? Yeah. Inefficiencies, arbitrage, and so on and so forth. Do you have conversations with people who are looking at this?
Absolutely, and to be honest, we also internally look at latency quite a bit, because we do know it can become a factor, and we just want to be cautious of that. And I think, again, this is where RuleMatch has built an extremely enticing offering, I think, for any hedge fund or low latency driven client to come in. I believe the reason it hasn't been such a big factor is, of course, when you look at the existing exchanges and whatnot, usually cloud-based infrastructure, meaning that latency will be higher in general, right? Exactly, right? So the typical advantages you could gain from the traditional world, it's very hard to gain them in the same way or manner in the crypto world, right? But I do think players are looking at it, and I think once fragmentation decreases a little bit, right? Once the market hits the next maturity stage, you will see the typical probably low latency players also having an increased focus on the sector, because that's when they will most likely thrive, I think, and take a bigger share of the market.
And will those players, do you think, come to Europe? Like we know there are players like that in, say, the US and so on. Will Europe be an attractive place for them?
To be honest, from the conversations we've been having, is that hedge funds so far haven't really been focused on Europe. I think, and then this goes for any asset class, really. Yeah. Like just looking back at my specific job, the last job I had at the bank, this wouldn't even exist in Germany, for instance, right? Because there's no market for it. So I think there's many factors that historically haven't really driven hedge funds into the European market. However, with the international, let's say, nature of the crypto market, I think it's less so, okay, maybe where's an exchange or a certain venue based, right? It's really, what do they have to offer? How's the product offering? And again, I think when you look at a platform like RuleMatch and they see the robust low latency infrastructure that can be offered, I don't see a reason why they wouldn't tap into that as well, right? But I do believe from a concentration perspective, most of those funds will, for the time being, stay Europe.
Where they are.
Exactly.
Yeah. I mean, we also sometimes talk about that, right? Europe is centrally located as far as the global market, and you see that with so-called price discovery, right? And crypto starts in Asia, moves across to Europe, and then to the US. Okay, the US still drives a lot of things, but then if you are sitting in between those two places, it's rather interesting, rather attractive. Can be, right?
For sure, from a timing perspective, absolutely, right. And I mean, I think when you look at the UK, for instance, there's a larger ecosystem and infrastructure of, let's say, pure buy side fund. Yeah. Exactly. Right?
Also, when you think about comparing crypto to FX, which we do quite often, right? There's that history in the UK market as well. Is there anything else that you would say hedge funds are waiting for or looking for to take the next step or to do things differently? It was interesting. We had a small, shall we say, hedge fund based here in Switzerland on the podcast, and they have 10 million AUM, but they turn it 10 to 20 times a day. So they're doing a lot of trading. But he was saying, we were early in crypto when things were even more inefficient and so on than they are now. And then they retooled the whole tech to take advantage of the next wave, kind of during the bear market. So some people are kind of on the second generation, but maybe some are still in the first generation of setting up with a hedge fund or moving from a traditional hedge fund into crypto. Anything else that's still missing gap-wise?
Yeah, I think when you look at the hedge funds or traditional hedge funds that have moved into the crypto space so far, these have largely been quant-driven, algorithm-driven funds, I would say, right? When you look at the crypto space, I think one core issue that still exists is maybe the lack of depth in terms of liquidity and market cap when you move outside of, let's say, the top 10 or 20, right? Which maybe for the bigger funds, it's hard to justify maybe why you would move into that if you have a directional focus, right? Or maybe a long-short, longer-term fundamental approach, right? Because I do think those strategies, and we've seen some already, but I think those strategies will continue to emerge. But of course, for those players, it's important to maybe have, let's say, a bit deeper liquidity in a larger variety of coins than we're seeing today to really move the needle and move in there.
Okay. Will be interesting to see how that progresses. I'm sure the next 6 months for sure will be interesting, 9 months and so on, as we see how the market progresses. Just on that topic, we always ask kind of to wrap things up, if there is something that you are seeing coming up or happening now under the radar that not too many people have noticed yet, and that you can give us a hint about, something to look for in the next 3-6 months.
Yeah.
Would you have anything in mind?
Yeah, there's I think two things that come to mind. But listen, overall, I'm just really, really excited for the market. I think we're in a great place. I hope it continues. We should all remember the crypto winter because
of course.
Should stay humble and enjoy the moment and then continue to work hard. But the two things I'm really excited about is, number one, on the tradias side, I think there's a few exciting clients we're going to announce over the next few weeks and months. So that is great. Borrowing lending, as I mentioned, is something we're looking into for 2025 besides our geographic expansion. And I think on the market side, it's interesting because everybody is talking about the U.S. election and perhaps deregulation being good for the market. And to me, when you look at the market, the main positive so far has been the Bitcoin price, right? But really, I mean, there's an approved Bitcoin ETF, right? So really, regulation has already basically taken a step towards Bitcoin adoption. I think what people underestimate is what deregulation can do for coins that are currently outside of the top 5 or have been bogged down or struggled under current regulation in the US, right? Basically being labeled as a security, therefore not being able to be offered on certain exchanges and whatnot. So I think those segments and those coins could be key profit takers, right? Of perhaps deregulation coming in, right? And that's a sector I'm very excited for. I'm looking at, right? Because to me, naturally, when you look at the story building around deregulation, this is where you should look at, maybe even more so than Bitcoin or the top 5. And
this also goes back to what you were saying about liquidity for coins outside of the top 10 being more interesting for hedge funds. So then if I just, for you, extrapolate it, you're saying that hedge funds will see deregulation for those coins as an opportunity to move into more assets than perhaps just the top 5, 10.
Again, if I was running a hedge fund, which I'm not, then this is something I would definitely look at.
Yeah. Very, very interesting. Yeah. Super. Chris, Beck, thanks very much for joining RULEMATCH Spot On. It's been a super interesting conversation. I think we for sure will have more things to talk about sometime in the future. So look forward to welcoming you back later on. Thanks a lot.
Yeah. Thanks, Ian. Was glad to be here. And until next time.